Stocks wavering on Friday after President Trump hinted more trade deals are coming. For more on the latest market action, let's welcome in now Skyler Weinand, Regan Capital Chief Investment Officer. Skyler, it's good to see you. So for investors, we've been talking a lot about this meeting this weekend in Switzerland between U.S. Chinese official talking trade. Skyler, I'm just curious, as a CIO, how you're thinking through that headline, through that event, and what it could mean for the market.
It still rings like a pretty big number. 80% and overall tariff levels are higher than anyone that's, a current investor has ever seen. We're going back to the 1920s to get anywhere close to the overall tariff number we're looking at. I think we're at 25%. For the market to have pulled back like it has over the last month, and investors basically being flat over all this turmoil just seems insane. Might be time to take some chips off the table on the equity side and kind of batten down the hatches and maybe be happy with a 5 or 6 or 7% return you might be able to get in fixed income over the rest of the year. Okay,
Skyler, let's dig into this a little bit, because the worst case scenario at one point were tariffs that were a lot higher, right? That sure. Those, the board with all those reciprocal tariffs that the president initially put up there. And we know we're not getting that scenario. But walk me through what you think is now going to happen that the market is not quite accounting for.
Yeah, so let's just say, that was the worst, that was the known, right? Okay, here's where tariffs are. And now we're talking about 80% versus 145% on Chinese goods. So what investors aren't thinking about, and we're only talking about goods, okay? You have an iPhone or you have an Android. I don't know if you're an Android person, but you think of your iPhone, you think of, okay, well, the price might go up on this from $1,000 to $1,400, okay? What you're not thinking about is all of the apps and services you use on a daily basis. Think about all the subscriptions you use. Think about Microsoft Office, for example. So this is super tangible. So the United States is a huge exporter of services. That includes software, that includes consulting, business consulting, that includes legal services. But let's just take Microsoft. Microsoft Excel and Word. What if China puts a tariff, and we're talking about, let's just say they're paying for Microsoft. What if China puts a tariff of 100 or 300% on Microsoft Office? What if the entire world does that? We're not even talking about that yet. So think about any firm that is selling their products internationally, especially software firms, any service company that hasn't entered anyone's mindset yet. That is this huge black swan of, well, what if services start getting tariffed to the tune of what we're talking about goods getting tariffed? That's what I'm worried about.
So Skyler, given those unknowns, given those uncertainties, and you sound more cautious here, how does that inform your investment strategy, your investment decision making? How do you want to be positioned?
Yeah, on the equity side, I would definitely hunker down a little bit more, focus on US-based businesses. If you're going to be exclusively a US-based investor, you have to think about and filter out some companies, or a lot of companies that have either a tremendous amount of exports internationally, if they're relying on more than 30% of their revenues from offshore, or if they're relying on more than 30% of their inputs from offshore. Okay, so what are my alternatives? Maybe looking at like discount retailers like a TJ Maxx or a Ross Stores, where folks might be trading down from a Neiman Marcus or a Nordstrom to like a TJ Maxx or Ross Stores. Also looking at, I brought up cell phones. Think about a T-Mobile or a Verizon who is charging customers at subscription. And those are all US-based customers primarily, Verizon is. And that I would say is more of a tariff-proof asset. Then when you look on the fixed income side, you've had this whipping around of the back end of the curve. Anything that has interest rate risk has been extremely volatile and extremely risky over the last 6 weeks. What hasn't been risky is the front end of the curve. And I'm talking about floating rate paper, very short duration paper that continues to put up 4.25% to 5.5% yield, depending on what asset class you're in, but stay short. And if you're a U.S. based investor and you want to continue to focus on U.S. based investments, stay local. Companies that aren't reliant on imports and exports as much as, let's say, a Microsoft might be.
What role does the Fed play in all of this, right? Because if what you're saying ends up coming to pass, right, and you do have the trade war sort of ratcheting up versus ratcheting down, one would think that then the Fed will step in and say, okay, we're going to cut if this is hitting the U.S. economy. So do you see that playing out that way?
The Fed said nothing this week, right? And I'm surprised the market didn't react more negatively to the Fed. The Fed highlighted, hey, there are a ton of ambiguities and we are in wait and see mode. I think they said wait something like 22 times in the press conference. And so they're in wait and see mode, and they have said they're going to treat unemployment and inflation equally. We can argue that if tariffs aren't getting materially better, inflation will be worse, but also unemployment will get materially worse. So I think, and the problem is you're not going to see those numbers for months. You're talking about July, August, September even before the Fed actually does anything. And we had a great unemployment report last week. 4.2% unemployment. Everything else was pretty steady. So the Fed is kind of taking the summer off. We're going to have to wait till September for, I think, the Fed to do much, unless for some reason unemployment kicks up to 5%. So the Fed's we're not going to see a Fed put anytime soon.